Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Welcome to the Global View on this Monday. Well, let's get into it just as far as what we're seeing at a macro level with the US economy adding fewer jobs than expected last month. However, solid wage gains and a drop in unemployment to 3.5% showed continued tightness in the labour market there. Nonfarm payrolls increasing by 187,000 jobs last month, less than the forecast of 200,000, but wage growth has picked up, running at 4.4%. Average hourly earnings year on year, far beyond the Fed's 2% goal. And that job status saw the 10-year yield fall nearly 13 basis points to 4.06%, with the market seeing it less likely that the Fed will lift its policy rate any further this year. Two-year yields were down to a two-week low of 4.79%. And the US dollar fell, paring most of its gains for the week. That weakness helped buoy the Aussie dollar, along with news that Chinese will lift their anti-dumping and anti-subsidy tariffs on Australian barley imports, the Aussie at 65.7 US cents. Well, last week's sell-off in equities and bonds was a stark reminder that we're not completely out of the woods yet. That is the view of Alfreda Yonka from Alfinity Investment Manager, who joins us now. Alfreda, good to see you.
Good to see you. Morning.
Well, let's start, in fact, with the US. What we saw, those jobs numbers slightly weaker than expected, although wages remaining a concern, clearly. However, that soft landing narrative appears to be broadening at the moment. In fact, I was taking a look at a note from JP Chase, their economists now saying their call for a recession is disappeared now. They're saying that GDP likely to grow at a healthy 2.5% annualised pace for the current quarter.
Yes.
Do you agree with that?
Yes, I think that sort of soft landing narrative has certainly been broadening across the board. It's not just JP Morgan. If you look at all the major research houses, they've all upped their sort of GDP growth forecasts. So I think this idea of a hard landing or no landing has certainly moved to a softer landing. On the one hand, you've got the disinflation trend, however, pretty well entrenched now, besides some of the wage data, as you mentioned last week, coming out and maybe a bit of a concern there. But on the other hand, you've had growth data being relatively strong and resilient, and it's not just been growth, it's also been US confidence, consumer confidence. You've had the US housing market stronger than expected. So it really is a bit of a dichotomy for central banks, because on the one hand, they really want to ensure inflation comes down, but on the other hand, they also don't want to break what we are seeing here as far as the soft landing scenario.
Yeah, hence they remain data dependent. We're seeing that, of course, locally as well. So how is this playing out, particularly with equities and positioning we're seeing at the moment?
Yes, it's been an interesting rally in global equities this year. Most investors have enjoyed quite good performance across the board, and it has really been a story of multiple expansion rather than earnings growth. So we have obviously spoken a lot about the Magnificent Seven that's driven majority of the performance this year, and a lot of influence on AI and money flowing in that narrative. But what we have seen of late is definitely a bit of a broadening out. So in May, the Magnificent Seven accounted for more than 100% of the returns, and if you look at current year to date, it's probably down to around 72%. So we are seeing that sort of positioning broadening out, and particularly of late we have seen cyclical starting to run, and also I guess probably a little bit more concerning, it's also some of the unprofitable tech stocks and some of the smaller caps that's run up quite a bit. So it does imply a lot of sort of optimism being priced in.
All right, well, that's sounding a little like a bubble, which I guess people are concerned about, particularly given this hype around AI, which has been driving so many of those tech stocks. So interesting then you're saying that those cyclicals are outperforming, particularly as far as the defensives are concerned. So I guess investors looking back at the past 6 months, but they've been caught unawares, haven't they, the strength that we're seeing with those cyclicals?
Yes, absolutely. Well, I think the cyclicals rally has really been over the last number of months only, not necessarily at the start of the year. And what is interesting, if you look at past cycles, normally when you want to see cyclicals continue to rally, you actually need a lot of strong growth. And it's normally not at the place where employment, as we currently see, is this tight. So in order to see a continuation of this sort of cyclical rally outperforming defensives and the world being a better place and all is well, you definitely need to see that earnings growth come through. And we haven't necessarily seen that yet. Even though this reporting season, for example, has been pretty good, you still really need to see a lot of growth.
Yeah, so let's take a little closer look then at what we've seen out of earnings season in the States, which has been better than expected.
Yes.
What's your overall assessment then of what we've seen there?
Yes, I think it's been pretty mixed. So we went in with very low expectations. The market expected the second quarter to be the trough in the cycle, around -9%, and so far it's come through -7%. But if you exclude commodities and energy, it's actually up 1%. So definitely better than expected. But I think the focus really remains on the outlook statements. And what we have seen is a lot of companies that's disappointing is seeing a bigger sell-off than what the companies are seeing on the upside that's sort of come through with positive results. So I think from here onwards, it really is all about the outlook and what they're seeing for growth and demand, particularly given that, inventory cycles have normalized now. You don't have that sort of COVID build-up yet. So it really is all about demand and those companies that can really give you the margin and the pricing power is really what you look for at this point in the cycle.
Any particular companies that you're focused on in that regard then?
Yes, we've got a lot of companies that we think has got fantastic pricing power. If you look at the results season out of the US, for example, companies that's come through with really solid results would be something like a McDonald's, which is on the defensive side, but they've come through with really strong pricing power and really doing well on the cost side as well. And we've also seen that in a number of the technical or the tech stocks that's really come through strong, like on semiconductor, for example, really strong. You've seen Google come through with very strong results and strong pricing power. So it is really across the board. There's not one sector or theme that I think you should play. I think really it comes down to stock by stock basis, finding those companies that can maintain margins.
And I guess it goes back to that original point you were making as far as the strength or the resilience of the US economy. Is that been playing out just as far as the resilience of the US consumer is concerned? Therefore, those consumer-facing stocks perhaps have been, are they undervalued at this point?
We are still a bit nervous about the US consumer. If you have a look at the US reporting season, consumer disc in general has outperformed and has done pretty well, but there definitely are some narratives in there that the US consumer is under a bit of pressure, and particularly those companies with big exposure into China as well. That sort of hockey stick effect that people expected after the opening has not happened yet. So there definitely are still some companies that we think have potential to grow further. Something like an Airbnb, for example, is in our portfolio, and that sort of travel narrative continues to be strong and play out. But we are definitely more concerned, particularly if you look at something like LVMH, that's been one of our really big positions for a long time. We've taken that right back because we have seen some softness in that high-end consumer that you haven't actually seen before in the recent results.
All right, well, let's return then to tech and the Magnificent Seven that we've been speaking about,
Yes.
and whether AI, we're in a bubble there at the moment. But you take a look at the results of those companies in that space at the moment, particularly the likes of Meta, you mentioned Alphabet, Amazon, a spectacular result, Microsoft. How do you sum up those results then, that strength that they're showing?
Yes, I think it's really coming down to every company and this whole AI narrative. When can you actually see that flow through into the bottom line? So the speed of monetization of AI is definitely going to be very different for every single company. And at Alfinity, what we look at is really stock by stock. When can this company see that earnings upgrades that we look for? And I think there's a lot of names, as you mentioned, in the Magnificent Seven that's still doing pretty well. But if you look at Microsoft, for example, which is one of our preferred picks, fantastic strong result, really across the board, beating earnings as well as revenue, strong demand. But if you have one negative comment like Azure not growing as strongly as people previously expected, you see a sell-off in that company. So we think you will see a lot of sort of short-term volatility, and then hopefully the market will continue to focus back on those earnings and fundamentals, and that's where we continue to like something like Microsoft as well as an NVIDIA, which we think is definitely still on the forefront of AI, and we'll see that sort of monetization come through earlier than some of the other names.
On the flip side, disappointing results perhaps then from Netflix, Tesla, and most recently, Apple.
Yes. So I think from that perspective, if you look at that at the results itself, a lot of optimism has been priced into those companies. So Apple, for example, best performing company here to date and biggest stock on the S&P. So when that stock falls, it really pulls everything else down. So if you look at what's priced versus what they reported, it wasn't necessarily a bad result, but it wasn't as good as people expected. And I think particularly missing on new iPhone sales, and if you look at the top line, it's still seeing negative growth. So for a company that's trading on a 32 times, it is just too high to justify that sort of lower than expected growth rate. So I think it boils down to being more selective rather than just buying anything and everything that's got AI associated with it.
How is China weighing on some of these companies at the moment, particularly selling into that market? You look at like Apple and Tesla, for instance.
Yes.
What's your outlook at China? Because so much speculation there, particularly as far as what we're going to see forthcoming in terms of stimulus.
I think it's been pretty disappointing so far for the whole market. What you have seen is other countries doubling growth in the year of reopening, and here is China struggling to get to 5% in the year of reopening without stimulus. And we've heard a lot of talk from the Chinese government on potentially supporting the housing market and supporting private investors, but we haven't really seen numbers there yet. So the reopening is definitely happening. It is happening, but it's just much slower than everybody expected. So our take would be is that shorter term, more volatility until you actually get a proper package with numbers that you can do your really pull through into models. But longer term, there definitely is, I would say, a lot of concern that China might be growing at 3-4% rather than the 5 to 6% we've been getting used to. So it definitely is something that a lot of these global conglomerates need to bear in mind when they do their future planning, is what sort of growth should we expect out of China, and obviously very important for the commodity outlook as well. So yes, shorter term, definitely happening, but not nearly as much as we should be expecting at this point.
Alfreda, great to get your perspective from Alfinity Investment Management. Thanks for joining us.
Thank you so much.
All right, that is the global view on this Monday. Just a quick check before we go. We are expecting a marginally lower opening there, as you can see, just over 0.1%. When we get going in just a couple of minutes' time, and that's when you'll be joined, the Dean, for the Open. Stay with us.